In this video, we will talk about Workhorse. Before the video begins, if you like my content, please consider to like, comment and subscribe to my channel for more. Workhorse Group Inc. has garnered attention from investors and electric vehicle stakeholders. In this analysis, we'll examine recent developments, the company's stock price action, technical analysis, and their implications for potential investors. Recently, Workhorse announced the beginning of W56 chassis production. The company's CEO views this as a significant milestone in their product roadmap toward commercial EVs. The W56 features advanced technology and is positioned as a growth driver for Workhorse. The company expresses confidence in securing firm purchase orders in the upcoming fourth quarter and beyond. Furthermore, Workhorse plans to start full W56 van production later this September, delivering production-quality demo units to major fleets in the fourth quarter. This underscores their commitment to expanding their EV offerings in the commercial vehicle sector. Regarding the stock price, the charts indicate a bearish trend. Both the exponential moving averages and traditional moving averages are downward, reflecting a downtrend. Dilution has been a concern for investors, weighing on the stock. However, it's worth noting that the stock appears oversold, hinting at a short-term bounce. For swing traders, setting a stop loss around the recent low of approximately $50 may be prudent. Nonetheless, caution is essential, given the risks associated with Workhorse's stock. The path ahead for Workhorse is still full of challenges. Dilution remains a pressing issue, and the company's fortunes are somewhat linked to the Federal Reserve's interest rate decisions. If the Fed continues raising rates, Workhorse may face funding difficulties without further share dilution. One potential catalyst for a turnaround could be the upcoming earnings report. Workhorse is expected to report $20 million in revenue, a target they have historically missed significantly. Meeting or exceeding this expectation could surprise the market positively and boost the stock. Workhorse is undeniably a high-risk investment in the current market environment. The company faces headwinds, including dilution and an uncertain economic climate for small-cap stocks. However, reasons for optimism exist. Workhorse's management team actively works on turning the company around, expanding their dealership network, securing grants, and demonstrating the viability of their EVs in real-world scenarios. There have been 18 million shares traded, compared to 30-day average volume of 16 million shares. In terms of the medium-term volatility, its share price fluctuated between $0.39 and $0.35 on a year-to-year basis. The traded share volume provides us useful information into market activity. It reveals the quantity of shares exchanged at a specific moment, thereby indicating the adequacy of liquidity to facilitate trading strategies. A low-volume float can make the stock price susceptible to manipulation and also suggests that the demand can be low. Comparing prevailing volume to the historical average can also show us potential for trend reversal or breakthrough when a substantial difference exists. For instance, a stock breaking through would very often have much higher current volume compared to its historical average. The market cap of Workhorse is currently at $95 million, compared to an enterprise value of $51 trillion in its enterprise value. The quick comparison between the market cap and the enterprise value often gives us an idea of whether the stock is trading at a premium or a discount compared to its intrinsic value. It is far from being a perfect measure, but it does offer us an idea of what the current momentum might be. A market cap that is higher than the enterprise value suggests that the stock is trading at a premium, probably because the market believes that the company can deliver in its promises in the future. On the other hand, if the enterprise value is higher than the market cap, then it is a sign that the company may have significant fundamental weaknesses or even solvency issues. When we look at the options market, the ratio between put and call options is 5%. 4.3 thousand contracts have been traded within the most recent day, and over the past 30 days there have been 4.4 thousand contracts traded. The options contracts can help traders to both hedge their risks and provide an additional revenue stream by selling them to others. The put options allows shares to be sold at a strike price, and the call options allow purchases at the strike price. They can be traded until the expiration date, and can tell us what the market sentiment is towards a company, although they might sometimes be wrong. When we look at the ownership structure of the company, 27% of its outstanding shares are owned by the institutional shareholders, some of the biggest institutional owners being Vanguard, State Street, and BlackRock. Typically, we would prefer to see institutional involvement if we decided to hold a stock for the long haul. This adds a level of stability and reassurance in the medium to long term. It indicates that the market believes the stock will provide value over an extended period, a crucial aspect for investors to weigh. In my view, a reasonable benchmark for institutional ownership would be in the range of 25% to 30%. However, it's worth noting that there are exceptions to this guideline, as some outstanding companies are predominantly owned by individual retail traders. Additionally, not all stocks are purposed for long-term investing either, making some equities worthwhile to be bought even if they have weak fundamentals and low institutional participation. Lastly, let's take a look at the short interest of Workhorse. According to Fintel, the short positions take around 21% of the total floats, and 55% of the short transactions are made in the dark pools. Short interest is important in stock markets. It measures how many shares of a company are borrowed and sold by investors who bet the stock price will fall. When enough people do this collectively, the measure becomes a hot topic. Short squeezes happen when the stock price rises unexpectedly. Those who borrowed shares must buy them back at higher prices, causing more buying, raising the price even more. The theory is that this would force short sellers' hands and bring large profits to the long positions. Short squeezes aren't common. They need high short interest, which isn't always present. Market conditions, company news, or social media can trigger them. Some stocks also have protective mechanisms, like circuit breakers. Timing short squeezes is hard. Investors may lose a lot if they put their money on the wrong stock or at the wrong time. Risk and uncertainty are always there. Short interest shows the number of positions people believe that the stock will tank. Short squeezes do occur but aren't usual. They have been the exceptions to the rule, and not the other way around. Predicting them can be tricky, as retail traders are often too optimistic in calling them. For those considering investing in Wkhs stock, conducting thorough due diligence and assessing risk tolerance are crucial. Employing risk management strategies like stop-loss orders for short-term trading is prudent. The challenging road ahead notwithstanding, Workhorse's recent initiatives and the potential for positive surprises in their financial results suggest that it may be a stock worth monitoring for the long term.